Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Hello, everyone, and thank you for attending today's webinar. We're going to spend about the next half hour discussing 10 financial strategies that most professors miss. I can see we've got quite a few people in the live presentation today, so thank you to everyone who's joining us. We'll also have an offer for our listeners at the end of the presentation today for a complimentary financial review, so make sure that you listen for that. I thought a little background on our team before we get started would be helpful. At Savant, we're a comprehensive fee-only fiduciary. Our university planning team has specifically been helping university faculty and their families over the past 25 years. So we have a good sense of what typical issues we see faculty and their families face as they approach retirement. We do have clients at over 50 different research campuses across the country, and we are familiar with the different retirement vendors and benefits plans. And today I'm joined by my colleague, John Clarke.
Good afternoon, James.
Good afternoon, John. John and I are both certified financial planners and member owners here at Savant. John has been advising university professionals across the country for the past 7 years, and I have been for the past 15 years. Our team has completed thousands of financial assessments, and we work with over 400 faculty and their families on an ongoing basis at dozens of research universities across the country. And we spend a lot of time with faculty when they're first introduced to our team, understanding their goals and what gaps might exist from a planning perspective. John, do you want to take a minute and share what we'll be covering during the webinar today?
Of course. This is something you and I have actually been talking about doing for quite some time, ultimately after having the opportunity to work with so many different families and helping them to take the first step to building a comprehensive plan. We both have seen just a common pattern of certain strategies that most professors miss when they're thinking about their finances. This should be fun. We'll keep it conversational and try to give you a sense of what professors are not thinking about that they should be. And I believe we came up with about 10 opportunities between the two of us to share with our audience today. So I think the most helpful thing we can do is as we share some often missed planning strategies is just reveal some opportunities for each of your financial plans for those joining on the call today.
Thanks, John, for walking us through the goal of the conversation. Why don't we get started? We can jump right into our first topic, which is consolidating your retirement plan accounts. And this might be the area where we see the most mistakes happen leading up to retirement. And to be honest, we could do an entire webinar on this topic alone. If you've been an academic for any serious length of time, it's not uncommon at all to have several different retirement plans. And it can be very hard to manage all those different accounts that have different rules at different custodians. The attraction to simplify the accounts is not only desirable in order to make your life easier, but it's also practical to help you make better decisions and better manage your investments. The mistakes that we see with this is that the plan to consolidate accounts is often dictated by one of the many custodians that you have access to wanting to custody all of your money in one place, or an advisor suggesting to consolidate all of your accounts with their preferred custodian. And that's certainly one way to simplify things, but you want to make sure that you are doing it for reasons that keep your best interest in mind. Many advisors and custodians will push account consolidation because it actually allows them to make the most money possible. You want to be particularly mindful of moving from a low-cost environment within a university retirement plan to a higher-cost retail IRA. And that's especially true if your advisor is receiving any commissions or 12B1 fees from the funds. There can also be motivation to sell expensive products like annuities that might not be in the best fit for your situation. So different custodians have unique strengths and weaknesses, however, so it can often be beneficial to use more than just one single custodian. And if you're working and making contributions to your plans, it just might not be possible to get down to one single custodian. So when you're developing a plan to streamline and reduce the number of retirement and investment accounts that you have, work with an independent fee-only advisor that is not restricted to one specific custodian. The fee-only structure also means that they do not receive commissions from your investment products, so they can objectively help you evaluate how to get the best out of your various accounts and then consolidate when it makes the most sense for you. Using software then to view the accounts for multiple different custodians as one unified portfolio is also a great way to increase efficiency and streamline your investment process when you're using more than one custodian, or it's beneficial for your only option.
Yeah, James, I think that's really good how you covered the consolidation process, and a nice transition into our next strategy, which is, just not taking advantage of those guaranteed funds within university retirement plans.
Yeah, almost all university professionals that have worked for an institution that uses, TIAA, Voya, or Securian as a retirement plan custodian, you've seen this at some point in your careers. And these insurance-based vendors offer a great tool that's often misunderstood and overlooked by participants and advisors. And these are called guaranteed or stable value accounts. TIAA traditional is probably the most common of these types of funds, and it even shows up as guaranteed on your monthly statement. These funds offer a guarantee of principal, and depending on the contract you're in, they offer either a fixed or a variable interest rate. And what's nice about this investment is that it helps you to avoid losses in bad markets while paying a competitive interest rate. When incorporated into your strategic asset allocation model, they can also fit nicely to supplement the bond portion of your portfolio. And when we see periods of time when stock markets and bonds are both down in performance, like we did in 2022, these funds don't lose any of their value, and they continue to pay anywhere from 1% to 4% interest annually. So this can be a great way to protect your income and reduce volatility during retirement. So instead of ignoring these options or looking for ways to liquidate these stable value funds as soon as you hit retirement, work with an advisor that can help you see if incorporating them into your overall investment strategy makes sense. And these funds can be very complicated, however, and have liquidity restrictions on them. So it's important to work with an advisor that understands those rules.
James, thanks for walking us through some of the mechanics to think about when it comes to guaranteed funds within a university retirement plan. Our next topic might be my personal favorite on the list, simply because many professors we speak to simply don't think they qualify for these types of retirement contributions. So James, how many times have you spoken to a university professor that believes they are not eligible to make Roth contributions? 100?
I would say probably more like several hundred.
Yeah, exactly. So this missed opportunity is extremely common, and understandably so. Many academics have healthy salaries and assume that the phase-out rules attached to Roth IRAs apply to Roth money that's being contributed into a university account. It's actually the opposite. So if you are single and you have an income of over 160,000, or you married and bring in 236,000 jointly, these phase-outs do not apply to you for Roth contributions that are being made within a university retirement account. So no income limit or restriction applies in that regard. That being said, ultimately, it's a plan rule. So most modern university retirement plans do allow Roth contributions within the plan itself. Contribution limits are going to be based on the limit for 403B or 457B plans. And you can typically make a combination of both pre-tax and then Roth contributions in a tax-advantaged manner as desired. And then those contribution limits are much higher, which I know is something you're going to expound on later, James. The opportunity here, though, is really to just build tax balance into the plan, because a lot of faculty simply have a tremendous amount of income taxes that are shadowing their nest egg. So to have a portion grow on a tax-free basis over time creates greater diversification from a tax perspective, and then just more opportunities when we're building a retirement income and an estate plan. And then I guess the final thing I will mention when it comes to Roth contributions is that the timing isn't always right. So with the healthy salaries that a lot of senior faculty receive while they are working, and some retirement plans not allowing Roth contributions, sometimes waiting until retirement, especially if cash flow needs are reasonable, can create a nice window for Roth conversions. Each professor's financial situation is a little different, but this is a good strategy to explore ahead of required minimum distribution age. And with a Roth conversion, you're just utilizing a part of your 403B account or outside retirement accounts like a traditional IRA, and then you pay taxes when you convert those assets to Roth. So you could receive tax-free growth and withdrawals moving forward. But there's a lot that goes into to seeing if that's a good decision or not such a good decision. So with Roth conversions, you don't have to worry about contribution limits. You can be a little bit more aggressive with those conversions.
Thanks, John. And you actually mentioned contribution limits within the plans, which is actually the next strategy that we're going to cover. And this is a very important topic because knowing the contribution limits for your different plans is usually the single biggest factor to how much you're going to have saved for retirement. And it can also be the most impactful thing that you have direct control over each year regarding your personal taxes. And what we have found by meeting with hundreds of faculty members over the years is that almost all of you can be saving more into the available plans. So as a kind of a reminder on how these work, 403B contribution limits for 2025 are $23,500. And if you're over the age of 50, you can save an additional $7,500 on top of that with a catch-up contribution. So that would be a total of $31,000 if you're over age 50. The Secure Act 2.0 also allows for a higher catch-up contribution of $11,250 for specifically participants that are ages 60 to 63. So your total would be $34,750 annually. In addition to the 403B plans, most universities also offer another plan called a 457B, which can allow up to the same $23,500 contributions. And some of those even have catch-up contribution allowances as well on top of that. So participants at some institutions could voluntarily defer $62,000 or even more of their taxable income into these retirement plans. On top of that, if you've done any consulting this year and you were paid as an independent contractor, there are additional options to save some of that specific income tax deferred with plans like a SEP IRA. And that's in addition to the limits that we just discussed through the university. So if you're a higher income faculty member at a university and you have self-employment income in addition to your salary, there could be an opportunity in most cases to defer over $100,000 of your taxable income this calendar year into those various plans.
Thanks, James, for sharing some of those strategies on how faculty can save a little bit more. The next strategy on our list actually relates to faculty's philanthropic endeavors. So oftentimes when we start understanding a professor's financial picture and we look at cash flow, if they're making charitable gifts, it's rarely done in a strategic fashion. So like most people, professors, you're gifting what you can, and often you're just doing it directly from savings or income that you're earning throughout the year. And if the gifts are sizable and the professor is over the age of 70 and a half, and the expectation is that these gifts are going to continue perpetually, having a strategy around your gifting can save you just a lot of money over the long term.
I agree, John. And that's where we get excited because that's often a lot of opportunity to add value from a tax perspective. You had mentioned gifting at age 70 and a half. Can you explain what gifting strategy to consider around that age or even later?
Yeah, absolutely. So what we're looking at in a professor's tax situation, they have a significant amount of pre-tax accounts typically represented by university retirement plans that they've been contributing throughout their career. And if you're over the age of 70 and a half, it's common that you've worked for a specific institution or several institutions for several decades at that juncture. So one opportunity that exists with those pre-tax accounts is you can gift up to $108,000 to a charity of your choice. So if you support specific nonprofits or your church or even institutions you've spent your career working for, this can be a great way to give back. And this strategy used to be pegged to your required minimum distribution age, but as that age has increased to 73 and eventually 75 in the future, this allows you to get a jump start on tax planning. Eventually, you can satisfy all or a part of the required minimum distribution through a qualified distribution, or a QCD for short. One big stumbling block that professors run into due to their asset makeup is, and this is a really important caveat to mention, I would write this down if you are charitably inclined, is these types of charitable distributions must come from IRA accounts. So mechanically, there's often work on our end when we're helping clients to identify the optimal amount to give from a tax perspective, and then to ensure that we have appropriate assets transferred from university retirement accounts to make that actually work in practice for professors.
Thanks for breaking that down for us, John. So if a professor is younger than RMD age, but their charitable gifting is still important and a part of their financial plan, what are other strategies that they might want to consider from a tax perspective?
Yeah, that's a good question, James. So another option to potentially explore would be lumping your charitable gifts or utilizing a donor advised fund in conjunction with that. So this type of gifting strategy can be really attractive for a professor where they have outside brokerage account assets with significantly appreciated holdings like stocks, mutual funds, exchange traded funds, and you can make a significant gift within a specific tax year to receive a tax deduction for that year, and then also avoid embedded capital gains in that one gift. So, and this can be used then in subsequent years to support multiple charities over those years. And that route would be a donor advised fund. The strategy that makes the most sense for each client is going to be a little bit different, right? QCDs keep adjusted gross income lower, which can help with Medicare premiums as well. So there's just like a lot to consider for each family situation, depending on their charitable aspirations, asset makeup, and then of course their age.
Yeah, it's certainly not a one size fits all approach when it comes to addressing tax planning for charitable gifts, but the magnitude of having a plan in place is undeniable when we see the amount of tax reduction that's provided by structuring that appropriately. Another commonly overlooked strategy among university professionals is not managing your investment accounts under a unified portfolio approach to reduce unintended risk. So once you have an appropriate asset allocation model established, you can enhance efficiency by treating all of your accounts, such as multiple 403(b) plans, IRAs, and brokerage accounts, as part of a single coordinated investment plan rather than separate standalone portfolios. And while consolidating accounts at one custodian, like we talked about before, may simplify management, it's not always feasible or beneficial. Employer plans often come with restrictions, and if you're still working, there's going to be ongoing contributions. Different accounts have unique rules, like RMD requirements on IRAs at age 73, even if you're still working. Tax exemptions in certain states, or special benefits such as the TIAA traditionals fixed rates that they pay a different contract. So instead of defaulting to consolidation, it's often more beneficial to understand each account's nuances and then manage them collectively toward a unified goal. And this unified approach helps you leverage the strengths and uniquenesses of the different custodians and optimize tax efficiency as well. And with your allocation and unified portfolio in place, then the final step is to keep your risk in check through ongoing rebalancing. And that's something that's really simple in theory, but one of the most frequently neglected practices among faculty that we see when they're managing their own retirement plans.
James, can you just walk our audience through how rebalancing the portfolio can be effective and how it's not what people often consider to be market timing?
Yeah, John, it's true that if you're going to try to time the market, that actually is usually going to hurt your returns, but rebalancing is not market timing. Rebalancing is a reaction to what's already happened. So we let the market do what it's going to do and then readjust to keep your risk level the same going forward. So let's say, for example, that you start the year with a 50-50 asset allocation model in your portfolio. So you've got 50% weighted towards stocks, 50% towards bonds or fixed income. And during the year, stocks do extremely well, while during that same year, bonds are flat in performance. So at the end of the year, if we fast forward, you are now going to have more like a 60-40 asset allocation and model instead of the targeted 50-50 model that we started with. And if we then fast forward again to the next year, let's say that in that following year, stocks don't do as well, and they actually go down by 10%, while bonds that year end up not doing so bad, and they're up by 5%. So if you did not rebalance at the end of that first year, your portfolio would perform significantly worse that second year, because 60% of the portfolio would have gone down by 10% instead of only 50% of it, and only 40% of your portfolio would have gone up by 5%. So rebalancing your portfolio is a very important way to control risk over time by systematically selling when the market's high to lock in gains and reduce risk, and then buying when the market's low to increase returns over time.
Thanks, James, for covering the portfolio in great detail. Our next topic is estate planning, and we're certainly not going to cover it all today. We have full webinars on this topic, but today we will focus on some practical steps that often require coordination. That's probably the key word here. So we have a team of estate planning attorneys to help, but knowing when and how to start that process can be super confusing.
Yeah, it's a complex area, but I think we can offer some quick opportunities to address what we see in initial financial analysis projects.
Definitely. So, one key step, especially for a university faculty member, is reviewing, and this might seem simple, but reviewing beneficiary designations. So even if estate documents like a will or a trust are in place, they don't override what's listed on beneficiary forms. So that means outdated or, just missing designations could cause assets to go through probate unnecessarily. And just given how much of professors' investments are often tied within retirement plans accumulated over their careers, reviewing both primary and contingent beneficiaries is essential.
That's a really actionable place to begin, John. But if a faculty member already has documents like a will and a trust in place, what are some other things they should consider?
Yeah, so another key point. So big issue is a stale document. So many people draft estate plans, at certain times in life. So when they first get married or have children, and then they just never revisit them. And that's not uncommon. Then we find aging parents on the documents, or even aging siblings still listed as executors or powers of attorney. And these roles are often, they just need to be adjusted to ensure that the right helpers are in place for your plan.
That's a good point, John. If you go back like 20 years ago, 25 years ago, the movie Mission Impossible 2 came out in the year 2000. This summer, they're releasing the 8th film in that franchise. And just because Tom Cruise is doing stunts at age 62, that doesn't mean your parents should still be the executors of your estate if they're in their 80s.
Couldn't have said it better myself. I'm sure Mr. Cruz appreciates that plug. So exactly, a good rule of thumb is to review documents every 5 years or after major life events. And even when people do create great estate plans, they sometimes just fall short. So let's say you go through let's say last year you went through the process of setting up a trust, but then guess what? You never funded it, actually. That final 10% of coordination is what makes a plan actually work in real life.
What are some final suggestions you'd have around estate planning?
Yeah, I mean, we touched on this earlier while you're living. So coordination with your charitable gifting too, at death. So as we discussed earlier, pre-tax retirement accounts can be a very, very tax efficient place to leave to charities, but only if you plan and structure that appropriately. So your gifting has to have some sort of structure in place with estate planning as well.
Thanks, John. So I think we can all agree estate planning can feel really overwhelming, but just starting with a review of what you have and then ensuring that your assets align with your intentions is a really powerful first step. And you gave us definitely some things to think about. So we are now at our second to last strategy, which is not claiming Social Security benefits at the right time. And this topic is particularly interesting for professors as a group because you tend to work longer than many other professions. Oftentimes, working past the age when your Social Security benefit actually maxes out. And as a quick high-level reminder, most people can start claiming Social Security as early as age 62, as long as you have enough credits. And if you claim benefits from age 62, until you reach what's called your full retirement age, and that ranges from age 66 to 67, and you still have work income, you will receive a reduction in benefits depending on how much you earn. But for university professors with your salaries, that often reduces it down all the way down to zero. So after full retirement age, so that's after either age 66 or 67, there is no penalty any longer for working at all, even full time, and still receiving your Social Security benefits. But you do receive an 8% increase in your benefits each year that you delay claiming up until age 70 when it finally maxes out. Also, if you're married, you can be eligible for a spousal benefit based on your spouse's earnings record. And it's important to keep in mind that up to 85% of your Social Security benefit is counted as income and subject to federal income taxes. And several states also tax Social Security income at a state level as well. So when you're thinking about claiming Social Security strategies, it can get very complicated very quickly. And we need to understand your entire financial picture, including when you will likely retire, what your total income from all sources is going to look like. Is your life expectancy affected by medical conditions or longevity? What is your spouse's work and benefit situation? What tax planning opportunities are we trying to explore, such as Roth conversions before RMD age? There's a lot of things going on. So with all these moving pieces that there are, if you do not consider all of this and all of these planning areas that will be impacted, you could really easily pursue a strategy that results in lower lifetime benefits or negative tax consequences and lost opportunities. So we are on the home stretch here, John. We're in the final missed strategy. What is that, and what can you share with our audience today?
Yeah, so thanks for covering Social Security, James. I think that was really helpful. This last misstep actually dovetails very nicely with an offer we have for those viewing our webinar today. So maybe it's because a lot of academics enjoy their research or they work later into their careers, but oftentimes we see faculty just wait too long to put a comprehensive plan in place, and then they miss out on some really large opportunities to enhance their financial future, some of which we actually covered on today's call. So ideally, we want to partner with a client when it's appropriate, and that timeline can vary greatly depending on what you have going on in your life. But typically 5 to 10 years out is a really nice starting point, especially if you have been putting off some of the items that we covered on today's agenda, and whether that's thinking through the best estate plan for your family, or how to maximize your supplemental retirement contributions. Some people get a statement and say, gosh, I don't even understand what I am contributing right now. We can help you with that. So, or building a portfolio, that's cohesive, like James talked about. Your different investment accounts require different consideration to get to that unified perspective. So building a holistic plan for you and your family, it's just really ensuring that we can help you make the best choices by understanding your goals and planning strategies that are most appropriate for you. So, the two of us really, we pride ourselves on getting to know our clients, and Savant does broadly, before we even engage formally, to ensure we have a comprehensive view before entering a formal partnership. So for anyone joining us today, we're going to be offering a complimentary financial analysis project to give you a sense if you're on track to meet your goals in retirement and to help you start putting that comprehensive plan in place. So this process is an opportunity to have a specific financial situation reviewed that's specific to you by a CFP named James or John. This assessment is comprehensive in nature and often gives faculty and members a tremendous opportunity to assess what they are doing, and then we will provide very specific recommendations to better reach your goals. And oftentimes that first goal is retirement. And then we'll help you review and ensure you're avoiding some of the common missteps we talked about today. So the outputs from this process are very detailed. So you'll receive detailed retirement income projections, several meetings throughout the process. We assess the current state of risk within your portfolio, and then we look for opportunities to put foundational pieces in place for your estate plan. And then in addition to all of that, we're looking for proactive tax planning opportunities for you in that process. So if you have interest in completing this initial analysis, there will be, or if you have any just one-off questions, there will be a survey immediately following the webinar where you can just message us, and then our team will respond to you directly. I just want to thank everyone that joined us today for our discussion. And then also, if you have time, encourage you to check out all the helpful information at savantwealth.com. And then we have a lot of university specific information on our university division website. So thanks so much for your time today, and I hope everyone has a wonderful day.
Thanks, everybody. Thanks, John.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.